I'm Elliot Gerson from the Aspen Institute. I'm delighted to see all of you here this afternoon. Lots of familiar faces, some not so familiar, and hope we'll see all of you tomorrow morning as well. I don't know if we started this tradition, Peter, 2 years ago or last year, but we're delighted here at the Institute to have our friends from the American Enterprise Institute join us for a session or multiple sessions. We're neighbors in Washington, and of course, the Aspen Institute is primarily a convening organization, and we are thrilled to have distinguished faculty members from the AEI join us. And what we're going to do this afternoon, continuing tomorrow morning, as you know, is have 3 conversations. Again, as I said, I hope I'll just start things off, and then we can all jump in with 3 very distinguished members of the AEI team. It's a little bit like starting with a domestic economic policy tutorial, then we'll move to foreign policy, and then tomorrow morning we'll cap that off with a discussion of philosophy, morality, and politics, or we'll see. Of course, for those of you not familiar with the AEI, and I suspect most of you, of course, are, it was founded, I think, about 7 years before the Aspen Institute was founded in 1943. And like us, nonpartisan, nonprofit organization, focused on a part of the AEI on government, economics, politics, and social welfare. And the overriding principles that define the AEI and whose members and fellows are all committed to are ones relating to the expansion of liberty, individual opportunity, and free enterprise, not just in the United States, but across the world. And of course, those are principles that I don't think anyone could deny are at the heart of not only the American system, but virtually all systems of government that have thrived and allowed human development to expand to its full potential. So we're very, very pleased to be doing this. First up is Peter Wallison, who is the Arthur Burns Chair in Financial Policy Studies and co-director of the AEI's program on Financial Policy Studies. Before he joined the AEI, Peter was one of the country's most distinguished banking and corporate lawyers, practicing with Gibson Dunn in Washington and New York, and has also had a very distinguished government career. From 1981 to 85, he was the general counsel of the United States Treasury, where incidentally he played a key role in President Reagan's proposals for deregulation. He was White House counsel after that to President Reagan. He has written a book, not surprisingly, on President Reagan, and he has written prodigiously since then on many subjects, especially those relating to financial issues and regulatory issues, particularly on Fannie Mae and Freddie Mac, and I'm sure we're going to be talking about that sometime this afternoon with him. He's also a frequent and always cogent and provocative commentator on the op-ed pages of the Wall Street Journal and New York Times and the Washington Post. He's now a member of the congressionally authorized Financial Crisis Inquiry Commission, which we'll also talk about, co-chair of the Pew Financial Reform Task Force. And finally, of course, he and Frida are very good friends and neighbors of many of us here in the Valley. Peter, let's start, before we go into a discussion of financial regulation and the financial crisis, with just, I'd be interested, I'm sure our audience would be, on your assessment of the economy today. I mean, it seems pretty terrible. And the Fed's recent action suggests that they worry as well that there is no imminent end to this deep recession, and that indeed it possibly could get worse before it gets better. Is this as bad as you've ever seen it in your career?
We've had, first of all, I'd like to say that I'm delighted that all of you came here today. I think it says a tremendous amount about the Aspen community that you'd come out in the middle of this, well, it's a cool and cloudy afternoon, but that you'd come out here anyway to listen to policy talk. That's an extraordinary thing. It doesn't even happen in Washington. So thank you all for coming here to listen to this. I am quite worried. I'm more worried today about our economy and the condition of the United States economically and financially than I have ever been. I think the remarkable thing about this particular recovery, it's not a recession. It seems like a recession. It's not yet a double-dip recession, but it does seem like a recession even though we are in something of a recovery phase. The growth that is predicted for the future is, to say the least, anemic. Something like 1.5 to 1.9% growth predicted for next year. This is quite extraordinary when you're coming off a serious recession. To give you an idea of how different this recession is from others, or the recovery is from others, when Reagan was president, we had a very serious recession just before he came in. In fact, prime rates were up in the 20 range. Unemployment was about 10.8%, which is much higher than it is actually today or ever got in this recession. But Reagan adopted a completely different policy for dealing with the recession. He adopted a tax cut policy, reduced regulation, reduced taxes, and relied on the Fed to follow what you would call a restrictive monetary policy that was intended to deal with the inflation that we had at the time. Now, the recovery in the first 4 quarters after Reagan's policy went into effect was about a 7.8% average growth rate and a 2% reduction in unemployment. If we take the 4 quarters that we've had in this economy since the bottom of this most recent recession, we have a 3.2% growth rate and going down rather than going up. So, to my mind, what this shows is that there is only one effective policy for dealing with a recession, and it's not a spending policy. It is not borrowing and spending. That doesn't stimulate. What stimulates are tax cuts and reduction in government's involvement in the economy. And to the extent that we have such a policy, we would see growth right now. We would see the V-shaped recovery we usually get after a serious recession. That isn't the policy that has been adopted by the current administration, and that's why I think we're in such serious straits.
Well, we'll come back to that in a few minutes, and I'll be interested in your reactions to Alan Greenspan's recent comments about taxes. But let me ask something else. President Obama likes to say, as you well know, that the Republicans drove this economy into a ditch, taking a Clinton surplus and then with deeply underfunded wars combined with huge tax cuts, and then, depending on what he says, either deregulation or malregulation over 8 years. Obvious you don't believe this, and so what is wrong with that picture?
Well, several things. First of all, I don't want to defend the Bush administration in particular, because I think that the problems we are facing today, and I hope we will get to talk about this a bit, the problems we are facing today are problems that were created by 2 administrations. The financial crisis that actually caused this recession was the result of housing policy that was followed by
both Clinton and Bush.
By 2 administrations, by the Clinton administration first, and then the Bush administration. So I don't regard this as a partisan issue. I think we have to look at what the federal government has done in the housing area, which created a tremendous number, actually 27 million subprime and Alt-A loans. That's about half of all mortgages in the United States, 27 million. And when those mortgages failed, as they did when the bubble began to top out in late 2006 and early 2007, that created weakness throughout the financial system. And that caused the defaults by many banks and investment banks, weakness and potential insolvency, and eventually the investor panic that occurred after the failure of Lehman. So driving the economy into a ditch, to blame that on the Republicans is a wildly inaccurate statement. But I won't say that Bush is blameless here, because his Department of Housing and Urban Development continued to follow the policy that was begun under Bill Clinton to require Fannie Mae and Freddie Mac and many other organizations, banks, and the Federal Housing Administration to buy a huge number of these very weak mortgages that became assets of our banking system and our investment banking system. And when those mortgages failed, those institutions got into serious trouble.
Well, let's talk more about the financial crisis. It seems like that you deny what maybe is the sort of the prevailing narrative, which is that government encouragement of home ownership was combined with inadequate regulation of the banking industry and the lending industry. And in your view, it sounds like that's wrong. That the problems really were the government policies themselves with respect to...
Yes, if we look at where the bad mortgages are, we can see what was really responsible for this problem. Because of the 27 million subprime and Alt-A loans that I was talking about 19 million of those are on the books of government agencies, either Fannie Mae and Freddie Mac or FHA, or the banks that were required under the Community Reinvestment Act to acquire these mortgages in order to get approvals from regulators for mergers. Now, if you look at where those mortgages actually are, you can see what happened. It wasn't a question of not regulating the economy sufficiently. It was a question of the government pumping a lot of money into or directing agencies that it had some control over to buy these substandard mortgages in order to follow a policy of reducing underwriting standards so that more people would have access to home mortgages, and so the home ownership rate in the United States would rise. And in fact, over a period of about 10 years, it did increase very substantially from about 64% to about 69%. But what was the cost of that? The cost of that is the crisis that we had in 2008 and the recession that we're suffering through today.
So what should we do? Let's talk more about Fannie and Freddie. What should we do about them?
Right now, I don't think there's anything we can do about Fannie and Freddie. I know a lot of conservatives, a lot of Republicans have ideas for privatizing them, and I certainly would be for that. I have been an advocate of that for many, many years. But right now, we have no other source for the funding that is necessary to keep our residential mortgage system operating. There were once two sources, basically. One was the banks that could buy and hold mortgages, and the other was a securitization system in which Wall Street and organizations like Fannie Mae and Freddie Mac would buy mortgages from banks, securitize them, and sell securities to investors throughout the world. When all of these mortgages began to default in 2007, the securitization system simply collapsed. This is a completely unprecedented thing. Most people here in the room, unless you're in the business, don't even know that this happened. But a gigantic market of many trillions of dollars simply stopped operating, so that mortgage-backed securities, and in fact some other kinds of securities too that were backed by, say, credit cards and boat loans and car loans and things like that. But mortgage-backed securities in particular could no longer be sold. And they no longer could be used for liquidity purposes. They were simply dead assets on the balance sheets of all kinds of financial institutions. And that came about because investors were shocked by the huge number of delinquencies and defaults that were occurring when the bubble started to deflate. And when investors saw that there were an unprecedented number of these defaults occurring, and of course that would occur because all of these mortgages were so weak, they fled the market. And no one was buying and no one was selling. So that's the central problem that I see here. This is the central problem that led to the financial crisis. And the reason why there is almost nothing that we can do right now to deal with the Fannie and Freddie question. Now they are backed by the federal government fully. The government is buying their securities. The government is giving them money to cover the losses that they will suffer. Those losses, incidentally, will probably be between $400 billion and $1 trillion, which you, the taxpayers, all of us, the taxpayers, are going to have to pick up at some point. But the losses that are suffered by Fannie and Freddie were just one kind of loss. All other banks and financial institutions that weren't backed by the government suffered the same kind of losses because they were holding these mortgages. So if we want to deal with Fannie and Freddie, we have to do two things. First of all, we have to wait for the securitization market to restore itself so that people come back to that market and are willing to buy mortgage-backed securities. Then it would be possible to privatize Fannie and Freddie. But up to that point, we have to, in order to keep our residential mortgage finance system alive, we have to rely on the two of them. The other thing we could possibly do is to come up with an entirely new system for financing mortgages in the United States. And thus far, I've seen no plans along that line. There is some work being done in Washington. Next week, the president will have a meeting with about 70 people from the financial industry, from the housing industry, and so forth, and they will discuss what to do about housing finance. But a meeting with 70 people is not going to solve the problem. Someone has to come up with a much more innovative system than we've had up to now. Otherwise, we're going to have to rely on Fannie and Freddie well into the future.
Let's just go back for a minute to the economy today and your prescription, and maybe ask about, Economics 101 AEI version. We have, as you said, we're in a serious recession, maybe not officially yet. Unemployment, not quite as high as it was in Ronald Reagan's day, but if you count people who have given up looking for work, it's over 10%. We have a structural deficit that's increasing at enormous levels. Yeah. And much of the policy debate is what can we do by way of stimulus? Do we do that now? Can we do that now? What do we do about spending cuts? What do we do about tax policy? And many people think that that you need to do both. You need to stimulate. You also need to think about tax cuts and perhaps spending cuts as well to deal with the deficit. You're sort of suggesting that's a false choice, and that tax cuts really alone are the appropriate policy even now, even to deal with the immediate issues that the economy is facing.
Well, I don't want to say that I don't think that spending cuts are necessary, but if we look at these questions as a matter of priorities, we have to get our economy moving. And our economy right now is declining. It has no stimulation in it. It's plain that an $800 billion stimulus package that the Obama administration developed and succeeded in getting adopted by Congress did not stimulate the economy. What Reagan did in cutting taxes did stimulate the economy. So although it is certainly arguable that cutting taxes now would increase the deficit, it is the one thing that would get the economy moving again. And to get our economy moving again is the first priority for all the American people. It will start to restore jobs. It will start to restore the kind of optimism in business and among the American people in general that can create a successful economy.
So I mentioned Alan Greenspan. He was here at Aspen about a month ago, and what he said the last couple of days was no surprise given what he said here. And he would actually go beyond what President Obama is proposing with respect to the Bush tax cuts and repeal all of them. Is he just wrong, or is he focused so exclusively on the long-term issue that he doesn't share your view about what needs to be done today?
That's the way I would interpret what he said. I was a little surprised by it myself, because although I've spoken with Alan Greenspan a lot, I have not spoken with him about fiscal policy. When he was at the chairman of the Fed, he was always going to Congress and talking about cutting spending. That was part of his main advocacy when he was asked in the many testimony opportunities that he had to talk about what he would do for the economy. He is very worried about the deficits, and everyone has to share that concern. The fact is these deficits are not only higher than they have ever been, but there doesn't seem to be any end in sight. We have reached a new plateau in terms of spending. And as long as we are at that plateau, there will come a point, and no one knows where that point is, where other countries are going to say we're unwilling to buy your debt anymore. Because the only way we can credibly imagine that you will handle your debt is to inflate your currency. That's the only reasonable way. You do not have any other way of dealing with the trillions of dollars of debt that you have racked up. We don't know when that point will come, but when it comes, we will be in very serious trouble. So I can understand why Alan's concern is much more about the deficit than about economic growth. I just happen to look at it differently because my experience in the Reagan administration was that the cutting of taxes put money in people's pockets immediately. It gave business the kind of encouragement, the kind of optimism that people need to start making investments and rehiring, and that resulted, as we all know, in a decade, almost a decade, of very high levels of growth and reduction in unemployment. That's the way I tend to see the world. And when the economy is working and people are earning money and people have jobs and they're spending money and they're paying taxes, if we can put a restraint on spending, we will eventually be able to get control of our deficit. But just trying to control the deficit by raising taxes strikes me as a self-defeating policy. We will further cut the growth of our economy, make it harder for people to pay taxes, and we will not have actually cut spending.
Let's go back to a regulatory issue. You mentioned Lehman Brothers a few minutes ago. Was it a mistake to let Lehman fail? And what should we do in general about companies too big to fail? What do you think about that whole issue of companies too big to fail and the Obama regulatory reaction to it?
Yeah. First of all, talking about too big to fail, we have absolutely no idea when a company is too big to fail. No one has any notion. In 1984, Continental Illinois Bank was a $40 billion bank. Wasn't one of the largest banks at all. It was considered too big to fail. There was a tiny little bank in a strip mall in Houston, Texas, that had made a lot of very bad mortgage loans, and when that tiny little bank was going to fail, the Fed, the chairman of the Fed at that point, which was Paul Volcker, called the chairman of the FDIC and said, we've got to save this bank because if it fails, it will cause a crash in our financial system. It's too big to fail, in other words. This can't go on. If we assume that all financial institutions that will cause some disruption when they fail are too big to fail, we will end up guaranteeing the liabilities of all our financial institutions, not just our banks. So what we have to do as a policy is to understand that the only effective way to control risk-taking by financial institutions is not to impose further regulation on them, but to make them transparent enough so that the creditors understand the risks they are taking. The creditors are the only people who are not benefited by risk-taking and are in a position to control the kinds of risks that financial institutions take. The managements benefit from risk-taking, as we know. The shareholders benefit from risk-taking because of the higher profits. The creditors do not. So we have to make sure that the creditors understand what risks are being taken. Now, what happened with Lehman Brothers, and was it too big to fail? What happened with Lehman Brothers was Bear Stearns. That was the original sin. When the government rescued Bear Stearns, it changed the market entirely and made the financial crisis that occurred after Lehman failed inevitable. The reason is that everybody changed their view of the world when Bear Stearns was saved. What were they thinking? The United States was now going to save every large financial institution other than Bear. That every large financial institution larger than Bear. And that certainly included Lehman and included a whole lot of others. So what did people do? People who otherwise would have raised capital at that point or shed risk at that point stopped doing it because they realized that to raise capital they'd have to dilute their shareholders, but if the government was actually going to rescue them anyway, there wasn't any danger of their becoming bankrupt. So why dilute your shareholders? Why drive down your stock price when in fact all you have to do is just wait until you're in trouble and the government will come in and rescue you? Organizations like the Reserve Fund, mutual fund that almost failed when Lehman failed, had kept some Lehman debt on its balance sheet. Why did it do that when it was well known in the market that Lehman was in trouble? Why didn't it take those losses, recognize them then? Obviously, the reason is it thought Lehman would be rescued. And if Lehman was rescued, it wouldn't have to take any losses. And on and on. If you tried to sell Lehman to another firm, why would anyone want to buy Lehman without any kind of government support? When Bear Stearns was sold to J.P. Morgan Chase with government support. So everyone who was a potential buyer for Lehman was waiting for the government to make a dollar offer. The problem was that we shouldn't have rescued Bear Stearns. We should not have assumed in March of 2008 that Bear Stearns was too big to fail. If it had been allowed to fail, then many of the things that followed would never have happened. Now, once Bear Stearns was rescued, then the government was bound to rescue Lehman. It had to, because it had established the policy. The failure to do that was a big error. But we have to remember that once we established that policy, everyone was going to have to be rescued. And at some point, there would be some institution that maybe wasn't as large as Lehman, or maybe was in a different business that was not rescued. And when that institution was not rescued, we would have the same kind of financial crisis. We have to create discipline in our markets, and we can't create discipline by allowing the government to come in and rescue everyone who is looking weak.
Stay on that. How do you create discipline in markets? And what is the way to prevent future financial crises, or are they just inevitable ramifications of the free market?
Well, let's get back again to what I said was the cause of this crisis. Well, the cause of this crisis was government caused by stimulating the development of all of these very weak assets that ended up on the balance sheets of financial institutions. The fact that the government did that is the reason we had a financial crisis. Now, that means that financial crises are not inevitable. They don't occur just by reason of the fact that a lot of risk-taking occurs and so forth. They occur for specific reasons. This particular crisis occurred because of government policies in the financial area, especially with housing.
And for future crises, one
of the ways you can avoid future crises, of course, is not to have the government inspire financial institutions or others to acquire all of these bad assets. So in general, how do we keep our market stable? If we don't have the government causing crises by stimulating the development of all of these bad assets, how do we keep our markets generally stable? And the way to do that is the way I put it is we need market discipline. We don't need more regulation. Obviously, regulation doesn't work. The commercial banks are very heavily regulated. Investment banks like Lehman Brothers and Bear Stearns and Goldman Sachs and so forth were very lightly regulated, but they both had exactly the same problems. So regulation is not a panacea. It is not something that will prevent crises. What will prevent crises is what I mentioned before, and that is awareness on the part of people who are being asked to provide credit to financial institutions that they are taking a major risk. And the only way we can do that is to make sure that these financial institutions are transparent in the risks that they are taking.
Just one question, and then I'm going to throw it to the audience. And do we have microphones in the audience? We do. So, and a simple one. Peter, how can anyone be opposed to something called the Consumer Financial Protection Bureau? Are you opposed to the principle of consumer protection, or is it the word bureau and something that represents?
Well, actually, bureau is a worrisome term, and I'll tell you why. We live in a democracy, and we control our government through our representatives. And one of the ways that our representatives control what the administration does, what the government in general does, is through appropriations. The Consumer Financial Protection Bureau is now a member of is now a part of the Federal Reserve Board. And it gets its financing from the Federal Reserve, which is an independent organization and earns its money through selling bonds. There's no appropriation anymore for the Consumer Financial Protection Bureau. It is completely out of control. The person who will be the single person who will be the head of the Consumer Financial Protection Bureau will be nominated by the President, confirmed by the Senate. After that, there is no effective control, even by the Fed, because the language that authorized this bureau said that the Fed is to have no direct control over the policies that the Bureau adopts. That's one problem. That's a major problem from my point of view with this Consumer Financial Protection Bureau. It's a good government kind of problem, and a serious one from my point of view, because this will be an agency that will be out of control forever. The second thing about it is this, and that is we know one thing about regulation, and that is that it increases costs, reduces competition, and reduces innovation. This organization covers everyone in the financial business throughout the country, no matter what size that company is. These are not just companies that provide credit, but companies that provide financial advice, companies that transfer money, companies that act as trustees, even the corner grocery store if it provides credit to its customers. They're all covered by this federal organization in Washington. That will increase consumer costs tremendously. And if we think in terms of balance, was there really a need to control how all of these companies, these tiny little companies all over the country, thousands of them, are dealing with consumers, when the downside of that is to reduce the likelihood that these companies will be able to continue to provide services to consumers. Many of them will be driven out of business by the regulatory costs. And will our consumers be receiving the kinds of support and the kinds of functions in the financial area that they need to do their business daily without having the tremendous costs imposed through new regulation? So from my perspective, this was way out of balance, and it came from a concern that, and this is where we get back to mortgages again, because it came from an argument that was made by consumer groups that these bad mortgages were the result of predatory lending and lack of regulation. Whereas, as I told you, these mortgages were bought by the government. There seems to be a view that you can create a very bad mortgage, you can create a predatory loan, and then you can always just sell it to someone further up the chain. Well, you can't. Everyone here who's ever been in business knows that to find a buyer, you have to have a quality product. It was the reverse in our mortgage system. The government was the buyer, and it wanted product that was of low quality. It wanted product that consisted of loans to people who might not actually be able to meet their financial obligations. And it got them. That's how we ended up with half of all mortgages in our system, Alt A or subprime.
Peter, your consistency on the issue of regulation is very impressive. I first met Peter in 1973, and you were opposed to regulation then, and even with the financial crisis, your principles remain solid and secure, and that is very impressive. So let's move to the audience, and let's start with this gentleman right here in the first row. And if you could just wait for the microphone, because we're recording this, just give us your name and then a short question, please.
Mr. Wallison, thank you for your comments. You've stated your case that government caused this debacle. All the things that I read was that the market caused the debacle. It was Goldman Sachs who just settled a suit for $550 million to the SEC. Countrywide just settled a suit to the SEC for predatory lending. That's $1.some billion. The market is not as honest without the regulation that it's been operating under. I don't see how the market's going to change unless this financial regulation that was just passed by our government can affect this change, because the market's not going to do it.
I think you all heard the question. Let me talk about Countrywide for a moment, because that's a really good example. Countrywide was the major supplier to Fannie Mae and Freddie Mac. Now, Countrywide made terrible loans. Made loans to people who could not pay those loans when they couldn't refinance or sell the house for a higher amount than the mortgage once the bubble period came to an end. Okay, but if Countrywide was making those loans before, it wouldn't have been able to sell them unless Fannie Mae and Freddie Mac were willing to buy them. And Fannie and Freddie wanted those loans because of government policy. The Department of Housing and Urban Development was insisting that they buy loans like that. So the question is, should we have regulated Countrywide to keep it from making loans that the government was demanding Countrywide make? This is not going to work. There's an inconsistency here. And so I think we have to look very carefully at this particular situation. On the general question of protecting consumers, I don't argue that there are circumstances in which consumers need protection. And we could certainly go through many areas where that is necessary, licensing of barbers and so forth, all of the things that states do that involve consumer protection in some way. That can be important. But in this particular case, what caused this financial crisis was not a lack of regulation at the origination level for mortgages. It was not the lack of regulation for the creation of these mortgages in general. It was the government demanding that these mortgages be made because they deliberately wanted to reduce underwriting standards so more people would be able to buy homes. That was a bad policy. That was the cause of the financial crisis. We shouldn't then say the real cause of the financial crisis was that we didn't regulate the originators of mortgages.
Okay, on the second table. And then the gentleman in the yellow sweater will be next.
Peter, excellent discussion. I'm Alan Altman here in Aspen. We haven't learned anything this past week. We have another bill, this time bailing out the pension funds of unions and teachers and so forth. So we're still doing this, and ultimately that's going to break the bank completely locally in the states, as we see in California, et cetera. Would you comment on not learning anything else, but also comment on the fact that all these bailouts and regulations are not only for fiscal policy, but towards a more devious end of running all of this, of having the government take over and run this? Please comment.
That question goes to the thing that I think worries me most about what has been happening in this country since the Obama administration came into office. And that is that there is an intent, a predilection, if you will, to take control of sectors of our economy. The most famous one, the one that got the most attention,
healthcare,
was, of course, Obamacare, healthcare. That's a very substantial portion of our economy and is now really under the control of the government. But exactly the same thing happened in the financial area. The Rahm Emanuel, the President's Chief of Staff, is famous for saying, "You shouldn't ever waste a good crisis." And here we had a financial crisis that was blamed on a lack of regulation. It's a very simple story. It's a simple narrative. It was picked up by the press. It was told to Americans day after day that this was a result of a lack of regulation, and that if you assume that that is the reason that we had this terrible crisis, then of course the American people would generally support the idea of greater regulation and control. So what we have now in this regulatory bill that was just passed and signed by Obama is a takeover of the financial system in a way that has never been controlled before. The Federal Reserve, under this system, will be able to regulate all the major financial institutions in this country, not just banks. It can be investment banks, holding companies of all kinds, hedge funds, anyone who the Fed and the other regulators believe is possibly a systemic risk. And as I told you before, the idea of systemic risk and too big to fail is a very fuzzy concept. No one has any idea what that really means or when it's a problem. But we have allowed now the Federal Reserve to take over the regulation of every large company. And what will that mean? It will mean that we will now have a partnership between government and the largest companies. This is a very dangerous situation. The government is going to protect them from failing, and they will do the bidding of government. That's the way it works. As I practiced banking law for many years, I could see what happened when a bank holding company, which was regulated then by the Fed, was required to do something. And they would say to me, "Well, what authority does the Fed have?" And I'd say, "Well, they actually don't have the authority to make you do that. So why don't you sue them?" And they would say, "What? We can't sue them. They're our regulator." And that is exactly the way things will work in the future if the Fed takes control of all the major financial institutions in our economy. So we are moving from healthcare now into the financial system, where we are losing the kind of adversity that we once had between private sector and the government. We are creating a system in which the private sector and the government are part of the same system. Very dangerous.
And many of those large companies willingly, if not happily in some cases, entering into those symbiotic relationships.
Absolutely. I'm afraid to say that that is absolutely true. Our large companies are very, very happy to enter into these relationships. It makes it very tough for the smaller companies to compete with them.
I think there's, I think the gentleman with the yellow sweater or jacket, I can't see from here.
Two questions. You are leading everything, our financial nightmare, all on the housing industry. The Fed itself, the question is, the Fed itself could have prevented it by raising the basic interest rate by 200 points. Is that true or not true?
I don't think it could have prevented it. In fact, the only thing that the Fed did in this area was to raise interest rates gradually in 2004 and early 2005, and that did bring the bubble to an end. That did cause the bubble to stop growing, and that just exposed the problems that were already in the financial system. As Warren Buffett once said, when the water goes out, you can see who's swimming naked. And that's exactly the kind of situation that we had. There was a lot of risk being built up in our economy with these bad mortgages, but it wasn't the losses weren't visible because as the bubble grew, houses were worth more. People who couldn't pay their mortgages could easily sell the house and pay off the mortgage because the house was worth more. Under those circumstances, we had no idea what was going on in the economy. Now, could the Fed, using its regulatory authority, not its interest rate authority, which is a very blunt instrument, but could the Fed have used its regulatory authority to say we will no longer allow any of these subprime mortgages to be made? Yes, the answer is yes, of course they could. But imagine what would have happened if they'd done that. Everyone in this country was very happy about how things were going at that point. Many, many more people were owning homes, and that's something we really want. We weren't thinking of the downside, but we did want more people to own homes. And as I said, the home ownership rate in this country went up from 64% to 69% in a 10-year period. That was an amazing growth rate. Now, if the Fed had gone to Congress and said, well, we're going to put a stop to this subprime lending because we think in the future it will cause us tremendous problems, Congress would have come down on them like a ton of bricks, because that would have meant whole millions of people, whole lot of people in this country would not be able to buy homes. And as far as anyone could tell, in 2006, there were no significant losses going on for the reason I described, because of the bubble. So the Fed would have been in a very weak position if it had tried to do that. The point is that these economic issues, these financial issues, are, and regulation in general, are very pro-cyclical. Congress likes things to go the way they are going when they are going well. And it becomes very difficult for regulatory agencies to stop this from happening as long as they are, as they all are, creatures of Congress. So I don't see a solution through regulation, and I don't think the Fed could have stopped all of this from happening by simply raising interest rates at any point along the way.
Sir, there's some other people with questions, so if it's all right, we'll come back to you if we still have time. Gentleman here?
I was surprised in your presentation that you didn't point out from 2001 to 2005, the Federal Reserve Board raised interest rates 525%, knowing all about these adjustable rate mortgages and causing them to become toxic, knowing all about the millions and millions of business loans. When you raise interest rates just a couple points, wipe out a bottom line, knee-jerk reactions to lay people off. 8 million people. I blame it all on the Federal Reserve Board. And look what they're doing now. They're down to 0.25% and saying we have no intention of raising interest rates again. So they made a giant mistake. Mr. Greenspan, who his nickname is I didn't see it coming, was a giant blunder by the Federal Reserve Board, and they're accountable to nobody, which is another problem in this country. They should be accountable to somebody, maybe Congress. I'd like your thoughts on that.
I think I disagree with some of your facts because the interest rates were quite low in the early 2000s. It wasn't until 2004 or 2005 that they started to raise interest rates. They were very low, and in fact, many people argue what I think the gentleman in the back was arguing, the gentleman in the yellow sweater, and that is that the Fed kept the interest rates too low for too long, and that stimulated the growth of this housing bubble. That is an argument that I think has to be taken seriously. I don't think it is the real result for the housing bubble. We've had periods of very low interest rates when we didn't have all of these bad mortgages created. The bad mortgages were called forth by government policy, not by the fact that interest rates were low. Now, did the Fed cause the recession by raising interest rates to 5.25%, as you suggested? I don't think that was exactly the number, but it doesn't really matter. The point is that the recession was not caused, in my view, by high interest rates. The recession was caused by the fact that the economy had become suffused with these very bad assets, which were these subprime and Alt-A mortgages. We have often had periods when the Fed has raised interest rates to deal with inflation. That has caused a flattening of economic growth. Sometimes it has caused mild recessions. In the last 20 years, the recessions that we've had have been very mild. But it's never caused the kind of crash that we had in 2008. And that was caused by something quite apart from the Fed's monetary policy, but by the things I spoke about earlier.
Let's go back to the rear of the room, the gentleman in the blue shirt. And if you could just give us your name and short question, so we'll have time for perhaps a couple after this as well.
My name is Eric Simon, and I appreciate the discussion, and I'd like to venture away from regulation for a second and talk about interest rates and tax rates. In the Carter administration, the interest rates went up dramatically, through the ceiling to curb inflation. And that increase in interest rates, in fact, curbed inflation. Then in the Reagan administration, interest rates were lowered so that we could now boost the economy. It seems that interest rates and tax rates have always been a major tool in either stopping the economy or boosting the economy. Here we are in a situation where our tax rates are low. We've cut taxes. We have interest rates at unprecedented low levels. It's almost getting to the point where we have to pay a bank money to keep our money in the bank. Houses have deflated. We no longer can raise interest rates because that would create a huge problem in the housing market and a huge problem with regard to our deficit. There's no room to lower interest rates. We can't raise taxes because we can't afford it, and we can't lower taxes because we have a deficit problem. It seems we've lost our ability to use taxes and interest as tools to govern the economy. I'd like your comments on that.
I suspect you don't agree, Peter.
Well, let me say that I think that this is exactly why Alan Greenspan is so worried, because we have lost all of the tools to deal with the problems in our economy, except one, and that is the tool of cutting taxes so that there's more money in people's pockets so they can spend, more money in business pockets so they can invest and hire. We haven't lost that yet, but we are about to lose that if I understand what the Obama administration wants to do. Now, I do disagree a little bit with what you said about interest rates in the Carter administration. Interest rates were very high in the Carter administration. That is because, in part, because inflation had driven them to very high levels. Then Carter made the correct decision to appoint Paul Volcker as the chairman of the Federal Reserve, and Volcker, probably without Carter's intentions, began to tighten credit, and that caused yet further increases in interest rates. That did tend to slow the growth of the economy, but the economy was already in pretty terrible shape. We had 10.8% unemployment when Reagan came into office. Reagan adopted a policy that accommodated the interest rate cutting that the Fed was trying to accomplish through first clamping down on credit and clamping down on inflation so that interest rates would gradually decline. The reason for high interest rates in many cases, of course, is that people are afraid of where inflation will be going in the future. So they don't. So they want to they will not lend their money unless they're getting a very high interest rate for it because they're afraid the money will be worth less in the future. Volcker tried to keep a control over that. It worked to some extent, but it was never opposed by Reagan, and interest rates did not go down very far in the Reagan administration, although the economy boomed and we had tremendous growth and reduction in unemployment. Interest rates were 10 or 11% in 1986, 1987. Interest rates really didn't come down all the way to where they were in the 90s and the 2000s until after Reagan had left office. So it's a very complicated process of adjusting for the Fed's policy of trying to control inflation and keeping the economy growing. But what I think Greenspan was probably talking about was exactly what you're pointing your finger at, and that is that nothing of our traditional controls exists right now. We don't have the freedom to reduce interest rates anymore. They're already at close to zero, and we can't increase our fiscal activities. We can't spend anymore because we now have huge deficits, and if we increase taxes, we're going to slow the economy further. My view, as I expressed at the beginning, is simply that you have to break out of this triad of problems. And the way to break out of it is to cut taxes so that more people have more money to spend, and business understands what they're going to have to pay in the future in order to hire people and begin to expand again.
We're going to need to pivot from fiscal and monetary policy to foreign policy in just a few minutes, but what I want to do is maybe ask for 2 or 3 questions, and then, Peter, you can use those questions to make some concluding remarks. This gentleman here is a woman in the back, and who else has a question they'd like to ask? And the gentleman over here with the sunglasses. So we'll have 3 questions, and then Peter will handle them collectively.
Thank you. I'm Tom Larkin. Sort of a follow-on question from what the other gentleman was saying of a lack of control of policy. I personally believe that in the equivalent of a historical heartbeat, we've managed to kill our country. Please tell me why I'm wrong.
That's a depressing thought. Another question.
Hi, Janie Simon, and you had made a couple comments, and I just wanted to question those. One was that you had said that you thought Fannie and Freddie needed to be revamped as a system for lending, and I wondered if maybe just the guidelines needed to be revamped, because deregulation of the guidelines sort of helped create the problem, I think, that we were in, not asking, having non-qualifying loans. People could come in and not have to say where their assets were coming from or where they worked, created a lot of the subprime problem. And that was sort of, I'm not exactly sure where the question is, but I think Fannie and Freddie are probably good systems in place. And then you made another statement, sir, saying that a lot of loans, a lot of people wouldn't be in housing if they didn't have the lending. And I think the problem were a lot of the jumbo loans where people were already in housing and maybe moving up to, bigger housing, and they didn't have to qualify for it or qualify for the down payment. And during the dot-com, some of the the assets that they were verifying were stock options that they didn't even have yet. So they had to go purchase the stocks that weren't there, and that's what they were using. So my question is that don't you think that deregulation helped create a lot of this? I'm sure that President Reagan didn't plan on it escalating to the level that it was, but don't you think that deregulating lending and the creation of mortgage-backed securities, selling them off in the stock market, some of the lending institutions could service the loans that they made. They, sell the loans themselves but maintain the servicing, whereas they were making the money on the servicing. They could take their bad loans and package them and sell them off to somebody else.
Okay.
Don't you think that that helped create some of the problem, the deregulating?
Thank you, and I think someone here.
Yes, my name is Don Keltner. I live here, and the Federal Reserve Bank announced they were going to buy $10 billion a month of Treasury bills starting this year. Will you give us your opinion of the result of that?
Can you weave those somehow together,
I think
Peter?
I probably can. Well, I don't know that I can weave them together, but they're all very good questions. Have we really destroyed our country? And the answer is no. This country will never be destroyed in any realistic sense because of the people who we have here, the skilled, ambitious, strong people who have always been the heart of this country. We will find a way out of this. But we have been put into difficulty by government policies. And we have to take control of the government again and return it to policies that do what has always worked in the past, and that is to encourage the growth of our economy so more people share in the quality of life here, and not allow the government to take over more and more sectors of our economy and run them. I mean, that is a course that will eventually do us great harm. But I think when the next election comes up, I think you'll see that many Americans understand what is happening here. It's much more complex than they probably imagine, but they understand that our problems are stemming from things the government has done, and they seem to want to take control of that. So I'm optimistic about that. Now, getting to the question of Fannie and Freddie, this is another example, I think, of the government's misguided policies. The way to get more home ownership in this country is not to force feed it like a goose from which you want to get pâté. The way to get more home ownership in this country is to have more prosperity, more jobs, better educated people. All of those things will improve our economy in a way that will make it possible for more people to buy homes. But when the government decided in the Carter administration, then continuing into the Bush administration, that it would try to push more home ownership on the American people, on people who actually could not afford to meet the obligations of a mortgage, we got into serious trouble. Now, the trouble, of course, has caused us to get to a point today where there is no action, no activity occurring in our economy, no real growth. In fact, people are just seemingly holding on, waiting for something to happen. And that's why the Fed has now decided that in order to keep some level of growth, it's going to avoid deflation, which would be a very serious problem. It is going to have to buy some U.S. government securities. This is a very rare thing. It's called quantitative easing, where the Fed is actually printing money by buying U.S. government bonds. That is not a long-term policy that will work. And that's the kind of policy that will cause people around the world eventually to doubt the stability of the dollar. And as I said, if they ever do that, we will be in very serious trouble. So we have to break out of the static situation we are in today. More government spending will just create more deficits. The Fed will be required to buy more government bonds. It will produce, in the future, probably some inflation or avoid deflation right now. But if we really want to break out of this problem, we really have to unleash the power of our private sector. And the only way to unleash the power of the private sector is to cut taxes and leave the people who do the investing, leave the people who do the hiring, leave the people who create the growth with the funds and the sense of optimism about the future that they need to do that. And up to now, I'm not seeing any of that from this administration or this Congress. And I, as a Republican, am very hopeful that after November, we will have a different Congress, and the statement of the American people will be so strong in November that even this administration, which is otherwise seemingly committed to the wrong course, will change course. But if they don't, at some point, the American people will change the presidency too. And that's the way, I think, we will eventually get out of this situation. But I'm not pessimistic at all about our future.
Okay, ladies and gentlemen, thank you very much, Peter. Don't go too far, and it's now my pleasure to bring up Danielle Pletka. Danny, where are you? But please, if you are going to take a break, we're not giving you a break because we'll never get you back. But you can individually. Men's and ladies' rooms are across.